Hi, everybody, and welcome back to video number 7 in chapter 21. And when we left off, we were looking at the solution for failing to record depreciation. And here in the illustration, since the machine was expensed in 2025, expenses in 2025 were overstated by $10,000. Causing net income and retained earnings, of course, to be understated by 10,000. Assets for 2025 are also understated because the machine was not recorded as an asset. Also, Hurley should have recorded 1 year of depreciation expense in 2025. And had they done that, we would have taken $10,000, the cost of the machine, divide that by 5 years useful life, and that would give us $2,000 of depreciation expense per year. So, alpha, if Hurley has not closed the books for 2026, the correcting entry would be as follows. We would debit equipment at $10,000. We would debit additional depreciation expense of $2,000, correct retained earnings for $8,000, and also record 2 years of accumulated depreciation at $2,000 per year for $4,000. The overstatement of expense was $10,000. Proper depreciation would have been $2,000 for 2025. Therefore, retained earnings was understated by that $8,000 as shown here. Now, bravo, if Hurley had closed the books for 2026, the correcting entry would have been to put the equipment up at cost, $10,000, correct retained earnings for $6,000. Here, the proper depreciation would have been subtracted from $8,000 to get to a $6,000 retained earnings understatement here, and accumulated depreciation of $4,000. Okay. Now, if we fail to adjust for bad debts, the companies sometimes use a direct write-off method in accounting for bad debts expense when an expected credit loss method using the allowance for doubtful accounts, allowance for uncollectible accounts, is more appropriate. So we're going to assume here that Hurley determined bad debt expense under the direct write-off method and expected a credit loss method as follows. Under the direct write-off method, we'd have $550 in 2025 with expected credit losses of $800. In 2026, direct write-off of $1,290 and expected credit losses of $1,500. So here we're going to prepare the journal entry to correct for this error on December 31, 2026, given that Hurley Alpha has not closed the books and Bravo Hurley has closed the books. So the solution then is to analyze the amount of the error for each year. So the bad debt expense recorded was shown as here. It should have been $800 here. So the bad debt adjustments would be $250 for 2025 and $210 for 2026. So if Hurley had not closed the books for 2026, the correcting entry would be as follows. We're going to debit bad debt expense for $210 here, and credit a debit retained earnings for $250 for the 2025 bad debt adjustment to correct the error, for a total on the allowance for doubtful accounts to be $460. So as you see, the allowance for doubtful accounts would be the addition of the $250 for 2025 and the $210 for 2026. However, bravo, if Hurley has closed the books for 2026, the correcting entry then will be a debit to retained earnings, the sum of the two 2025 and 2026 correcting entries, and a credit to the allowance for doubtful accounts of $460. Okay, here we have a comprehensive example, and in some circumstances, a combination of errors occurs. So the company therefore prepares a worksheet to facilitate the analysis. The following problem demonstrates the use of the worksheet. The mechanics of its preparation should be obvious from the solution format. The income statement of Hudson Company for the years ended 2024, 2025, and 2026 indicate the following net incomes: here, here, and here. An examination of the accounting records for those years indicates that Hudson Company made several errors in arriving at those net income amounts reported. Number one, the company consistently omitted from their records wages earned by workers but not paid at December 31. So those amounts omitted were December 31, $1,000, December 31, 2025, $1,400, and December 31, 2026, $1,600. When paid in the year following that in which they were earned, Hudson reported these amounts as expenses. All right, so number two, the company overstated merchandise inventory on December 31, 2024 by $1,900 as a result of errors made in the footings and extensions on inventory sheets. Number three, on December 31, 2025, Hudson expensed prepaid insurance of $1,200 applicable to 2026. Number four, the company did not record on December 31, 2025, an interest receivable in the amount of $240. And finally, number five, on January 2nd, 2025, Hudson sold for $1,800 a piece of equipment costing $3,900. At the date of sale, the equipment had accumulated depreciation of $2,400. The company recorded the cash received as miscellaneous income in 2025. In addition, the company continued to record depreciation for this equipment in both 2025 and 2026 at the rate of 10% of cost. Woo, I think I'd be looking for a new accounting staff for all of this. In any event, what we're going to do here on the balance sheet errors is create a worksheet to try to get a handle on all the amounts and the correcting entries. So here's the wages unpaid, here, here, and here. And so here's the inventory overstatement here, self-correcting in 2025, prepaid insurance, self-correcting in 2026, the interest receivable, self-correcting in 2026, and the correction made upon sale of equipment for $1,500 here, and we have some balance sheet effects for that too, but we'll get to that in a second. The overcharge of depreciation for 25 and 26 for $390 each. So we have some balance sheet corrections for these last two entries, and the wages that we paid here and the accumulated depreciation of equipment here. All right, so the corrected net income then in red here would be as shown on the, and the cost for this entry here for the sale of equipment, it cost us $3,900. The accumulated depreciation was $2,400. The book value was $1,500. So we had less the proceeds from the sale of $1,800, leaving us with a $300 gain. So the income that actually was reported was $1,800. So we need that $1,500 adjustment that you see here. Okay, a combination of errors. All right, so if the company had not closed the books, we're going to make our $1,400 correction here to retained earnings and salaries, wages. We would have a debit for $1,600 to salaries and wages expense and a credit to salaries and wages payable for $1,600, shown here, and insurance expense of $1,200 and retained earnings of $1,200, shown here. And then our interest revenue of $240, a credit to retained earnings, and then a debit to retained earnings for $1,500, a debit to remove the accumulated depreciation here of $2,400, and a credit to remove equipment of $3,900. Little complicated journal entry there. And then finally, accumulated depreciation on equipment, $780, and that was the depreciation for 2026 correction and the correction for the prior year to retained earnings. So that's if the company had not closed the books in 2026. Now, had it closed, assuming they have not or have not been closed as follows, we would continue on with if they have closed the books for 2026, then we would have the $1,600 correction here to record the proper wage expense for 2026. We'd have retained earnings for $1,500 and $2,400 accumulated, as well as a credit to equipment here for $3,900, and that's to record the write-off of those equipments in 2025 and the adjustment of retained earnings. And lastly, to correct the improper charge for depreciation in 2025 and 2026, we would debit accumulated depreciation dash equipment for $780 and credit retained earnings then for $780. All right. So we'll start with this illustration. Dick and Wally's Outlet is a small retail outlet in the town of Holiday. Lacking expertise in accounting, the company does not keep adequate records, and numerous errors occurred in recording accounting information. Number one, the bookkeeper inadvertently failed to record a cash receipt of $1,000 on the sale of merchandise in 2026. And number two, accrued wages expense at the end of 2025 was $2,500. At the end of 2026, $3,200. The company does not accrue for wages. All wages are charged to administrative expenses. That looks like a good place for us to stop this video. And when we return, we'll take a look at correcting those errors. Until that time, bye for now.